Hey everybody, welcome back to Accounting 1101. Now we got a big week in our week coming up here because our beloved company, great company, is going to open the doors and begin selling to people. We're going to let customers in, we're going to sell them stuff, and we're also going to pay a few of the bills that come up as a part of that process. So grab your coffee, grab your Mountain Dew, whatever you need to stay awake. We're going to break it up into two parts. So I don't have like a 2-hour long video here. We'll break it up into two parts. After part one, you can do a little bit of your homework. Then come back, look at part two, and finish up that chapter 4 homework. Now, the other thing, I'm skipping chapter 3 in solid footing, and I'll tell you why kind of as we go along in the video. Chapter 3 kind of tells us how to do something. And then in chapter 4, we say, well, chapter 3 is not the way it's really done. Here's how it's really done. I'm not a big fan of that. I want to show you how it's done in the real world instead of showing you the wrong way and then showing you the right way. So here we go. Chapter 4, strap in, revenue and expense accounts. We're finally opening the doors. We're finally going to sell a little bit of product here. So what you need to know by this point. We've done chapters 1 and 2 in solid footing. You need to know that accounting equation. You should be able to recite that off the top of your head. Assets equal liabilities plus owner's equity. And you need to know what it means. You need to understand how that kind of dictates how account amounts go up or down, depending on what side of the equation they fall on. You need to know the difference between that journal and the ledger. And the journal is where we put the transactions. The ledger is what keeps a running balance of every account. You need to know how to make a journal entry correctly and how to post it. And I made a little video, you can check it out, those journal entry do's and don'ts. And then finally, you need to understand the trial balance, the purpose of that is, and the balance sheet. If you don't have a handle on that, you need to go back and study and reread chapter 1 and 2 and look at the videos again, look at the homework walkthroughs, or ask for help. And I mean that with all sincerity. If you don't understand chapters 1 and 2 and what we're getting ready to talk about in 4, you are in a bad place because everything from here on out builds on what we talk about in chapters 1 through 4. So if you're stuck, if you don't have a good understanding, you need to put the brakes and pump them. And we need to talk. Okay? Don't expect that, oh, well, I'll probably just pick it up as we go along later on. That's not going to work. If you're lost right now, you need to take the steps to get up to where we need you. Okay? Don't expect that it will just magically happen later on. You'll get better with practice. You'll get more comfortable with practice. But if you're way out in left field right now, then we need to talk about that. Okay? And we need to do some work. So, at this point in the game, we know a little bit about what we call owner's equity. That right-hand side of the accounting equation, we've talked a little bit about what owner's equity is. It's the money that owners have put into the company. And right now we're talking about a corporation, so that's reflected in an account called common stock. The amount that the owners contribute, they get common stock to reflect the fact that they've invested in the company. And right now that's all we have under owner's equity. The only way up to this point in our accounting system to show what the owners have in the company is through common stock. But there's another way. There's another way owner's equity can go up. Not just owners giving money to the company in the form of an investment. There's another way our owner's equity can go up. And that's when a business makes a profit or when they have more income, money coming in, than expenses going out the door. That profit that a business earns makes owner's equity go up. You've heard the phrase, to the victor go the spoils. Well, to the owners go the profits. So profits make that owner's equity go up, but not through common stock. We got to have another account. So what we're going to talk about in chapter 4 is a new account called retained earnings. Now, retained earnings is exactly what it sounds like if you break that name down. It's in the name. Retained. If you think about retained, it means to hold, right? Use a football example where at the end of football season here, if a receiver retains possession, that means they hold on to the ball. And think about maybe a woman that's pregnant They retain water. They hold on to water. As to whatever example you want to attach to it in your head. Retain means to hold. Earnings means profit. The profits that a business has earned. So you put all that together. Retained earnings means profits the business has held on to. They haven't spent them. They haven't had expenses for them. So to put a little definition to that, retained earnings, put it all together. Earnings or profits a business is holding. Earnings and profit, exact same thing. Earnings and profits held by a business. And that's cumulative. All the earnings that the business has earned and hasn't spent. All right, retained earnings. They're holding on to the earnings. So we have a new account that lives under owner's equity. So owner's equity can go up in two ways now. When an owner invests in the company, we call that common stock. Or when the business makes a profit, that profit goes into an account called retained earnings. Simple enough. So that profit process where we earn money, that happens when a product or a service is sold. That's called revenue or income. So you think about like Walmart. Every time you go to Walmart and you hear that register go beep, 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 and scan in a product for a customer that's buying it, that's revenue for Walmart. That's income from Walmart. So when we sell something as a business, we get something in return. We get an asset. Normally it's cash, or maybe the customer gives an IOU and says, hey, we'll pay you later on. And the business says, okay, we'll let you do that. So that's one side of the profit process. Money coming in, revenue, income. The other side are all the expenses that we have in conjunction with selling whatever we're selling. And think about Walmart. You think about the labor that goes into it. That's an expense, isn't it? They have to pay all the cashiers. They have to pay all the stock people. They have to pay all the folks on the floor there. And then look at all the equipment Walmart has. They got cash registers. They've got conveyor belts. They've got inventory that they've bought. All that stuff is an expense. It's part of doing business. Then you think about the electricity, the utilities, the heat, and all that stuff going on. All those are expenses. So we take our revenue coming in, we subtract out the expenses that we had to generate that revenue. The difference, hopefully if it's positive, is profit. And that profit, or maybe if we didn't do a good job, we had more expenses than revenue, we had a loss, that flows into retained earnings. All right, so that's kind of what we got going on here. Now, chapter 3, the chapter I'm skipping in solid footing, has you put all of that stuff into retained earnings directly. So when we sell something, it makes retained earnings go up. And in chapter 3, all your sales are just recorded directly to retained earnings. The flip side of that coin is when we have expenses, retained earnings goes down. All right, because our profits are going down when we have expenses. Makes sense? And in Solid Footing Chapter 3, it has you put all of your expenses as a debit to retained earnings. You can see we have all these numbers right there on the debit side. All those are expenses. So that's what Chapter 3 shows you, okay? It has you put all your sales in as a credit to retained earnings and all your expenses in as a debit to retained earnings. Here's the problem with that. If you're looking at the debit side of retained earnings, you have 5,000, 700, 1,000. I have no idea what that is. Maybe it's rent, maybe it's wages, maybe it's interest, maybe it's where I paid for the inventory before I sold it. I have no idea. As such, I can't manage it. I can't manage my expenses, and I don't know what I need to maybe cut back on if I don't know what they are. So Chapter 3 does this for illustration purposes. It wants you to see how sales and expenses flow into retained earnings. Okay? The problem with that is that's not the way we do it in the real world. In the real world, we have separate accounts for all of our expenses. And we have separate accounts for all of our types of sales that we have and our revenue coming in. So that's what we're looking at in chapter 4. This is what chapter 4 is. This is how we do it in the real world. We have a separate expense account for every expense. So I have rent expense, wages where I've paid people, interest where I've paid interest to the bank, and cost of goods sold, which is the cost of what I paid for the inventory that I sold. And then over here we have a separate account for sales revenue. Okay? So all these accounts, like my sales revenue account, it flows into retained earnings in a process that we learned in chapter 5. All my expense accounts, they flow into retained earnings and make it go down. So that flow, we learn how that happens in chapter 5. We learn the journal entries to make that happen. In chapter 4, we're concerned about how we get the revenue transactions and the expense transactions into the accounts. Okay? Now, other thing I'm going to say. I told you before that where an account is under the accounting equation dictates what side it goes up or down on. So we're under owner's equity. That's on the right-hand side of the accounting equation. Means it would go up on the credit side and down on the debit side. But if you look at these accounts on here, some of them don't follow that pattern. Sales revenue goes up on the credit side, so it follows the pattern. You can see it makes retained earnings go up. But if we look at those expense accounts, it looks like all those expense accounts are going up on the debit side. And they do, even though they're on that right-hand side of the accounting equation. And this is really confusing to people when they start out. You may just have to memorize it. But what's happening is the reason these all go up on the debit side is when we close them out to retained earnings, they're making retained earnings go down. And we see that process in chapter 5. So you may just have to take my word for it until we get to the next chapter. But all these expense accounts are going to go up on the debit side and increase on the debit side. So with that being said, we got 2 new accounts that we're going to talk about in addition to retained earnings today. We got an account called accounts receivable and one called interest payable. Now that account receivable account is simply when a customer buys on an IOU. So a customer comes in, they buy something from us. They don't pay us cash right away. They say, hey, we'll pay you later. We now have an IOU. So that's an asset. When a customer promises to pay later, we expect them to pay later. We expect to receive that money. It's a receivable. We expect to receive it. Interest payable is when we expect to pay money to the bank. We have a payable. We owe the bank money for interest, just like we owe the bank money that we borrowed. So in accounting, when you see the word payable, that means you owe somebody some money for something. Okay? When you see the word receivable, that means somebody owes you some money. Simple enough. Receive, you expect to get money. That's an asset. Payable, you have to pay money. It's a liability. So we got 2 accounts that we're going to deal with there. Then we have our new revenue account. When we sell, we're going to make credits to that revenue account. Eventually, it will get dumped into retained earnings. When we have expenses, we'll make debits to the appropriate expense account. And in chapter 5, it gets dumped into retained earnings. All right? Woo! A flurry of accounting activity here. Take a deep breath, maybe hit the coffee again, maybe hit the Mountain Dew again, and we'll move forward into a few transactions here. So transaction number 1, here we go. The doors are open. Gray Company welcomes customer number 1, and we make a sale. February 1, 2021, Gray Company makes a sale of inventory to a customer. So we're selling inventory. We're going to get something in return. What are we going to get? Cash, or are we going to get an IOU, account receivable, where the customer is going to pay later? Inventory is sold to the customer at a price of $9,000. the customer pays cash. Oh, okay. So the customer brings $9,000 in and buys inventory. We had paid $5,000 for that inventory. So I got two transactions I need to make here. I got to record what I sold and how much I got, and I got to record how much I paid for it. Two things going on. So here we go. February 1 is my date. And we're going to date the transaction. And I got to make two entries. I got to make an entry to record how much I got for the sale. I got to make an entry to record how much I paid for that inventory that I sold. So it says we got $9,000 in cash. So I'm going to make that cash account go up. That cash account is on the left-hand side, meaning it goes up on the left-hand side, on the debit side, and down on the right. Okay? So I'm going to do a cash debit right here with my beautiful handwriting. $9,000. How did I get that $9,000? What did I do to get it? Did I borrow it from the bank? What's going on here? So the way I got that $9,000 is I sold stuff. I got sales revenue. So if I know I've got $9,000 in cash here on the debit side, that sales revenue must be my credit. So I'm recording the sale and what I got from it. I sold $9,000 worth of stuff, and I got $9,000 in cash. Let's go ahead and post that down here to the revenue part, $9,000. Now, that's the part of the transaction where I record selling and what I got for that sale. Now I got to record the part of the transaction where my inventory goes away. I don't have that inventory anymore because the customer literally took it and walked out with it. All right? So I've got to record the expense of what I paid and that inventory leaving. The expense of what I paid for that inventory that was sold is simply called cost of goods sold. Now that is an expense account. Even though it doesn't say it, you can think of it as cost of goods sold expense. And a little secret here. Your expenses, always when we initially record them, going to be a debit. Okay? The only time we're going to credit an expense account is if we screwed up something and we got to fix it, or we're closing out that account like we learned about in chapter 5. So your rule of thumb, if you're trying to record an expense, it's a debit. Cost of goods sold is how much I paid for that inventory. Cost of goods sold, it said we paid $5,000 for the inventory, I believe. Just to make, yeah, $5,000. Ooh, that's not a number. Pretend that's a dollar sign. So cost of goods sold, what I paid for that inventory, $5,000. And now I've got to get rid of the inventory because I don't have it anymore. Inventory on that left-hand side goes up on the left, goes down on the credit side or the right. So I'm going to credit inventory $5,000. And I'll post it right here to that inventory account along with my debit. Okay, so the two transactions. I have to record the sale and what I got for it. I have to record the inventory leaving and what I had paid for it. When I buy inventory, it's an asset. It sits on the shelf waiting to be bought. When I sell it, it's gone. It becomes an expense. All right? So you think about Walmart. They buy a box of candy bars. They got it sitting by the register. That's an asset until somebody comes along and buys that box. It's gone. It becomes an expense. So in that sale, we've made a profit of $4,000. We sold for $9,000. The expense was $5,000. So we made a profit of $4,000. We don't have to record a $4,000 entry that says profit. It just naturally happens because revenue minus expenses in our financial statements. So that's transaction number one. We sold inventory. We do that transaction 1,000 times in accounting, it seems like. So it's important that you understand what's going on there. If you look at solid footing at that point in time, everything put together in the general ledger. There's our entry to cash where we got the money. New balance, $15,000. We have our credit to revenue, debit to cost of goods sold. And now we're down to $2,000 in inventory. We had 7 that we bought in January and February. We sold. So now we're down to $2,000 of inventory. February 2nd, Gray Company pays the landlord money for rent. $700 cash for February rent. So now we got money going out the door. We have to pay rent. When we pay rent, that's an expense. We've used up rent. So February 2nd, we paid, it said $700 to the landlord for rent. So you look and see we got an account for rent expense. Recording the rent that we've used up. Rent expense. Most landlords won't take a hug in the form of payment for rent. They want money. So we better give them some money. $700 is a credit to cash. And again, left-hand side of that accounting equation, assets are going to go down on the credit side. Your expenses always going to be debits when we record them. The only time we have a credit on an expense account is if we messed it up and we're trying to fix it, or we're closing it out. We'll talk about closing again in chapter 5. Rent, expense, debit, cash, credit. So there we go. We recorded paying the landlord $700 in rent. We update. Now we have $14,300 left in the cash account. So again, the journals where we record the transaction, it gets posted to the ledger. The ledger keeps a running tab of the balance in every account. Transaction number 3, we're going to pay our employees. The employees want to be paid after a week or so we better give them a paycheck. February 7, we pay $1,000 to our workers for their first week of work. So cash is going on. We got cash going out the door, and we have an expense of labor. We got wages that we had to pay. So February 7th, date our transaction here. We got wages expense. We got cash going on. Again, your expenses are going to be debits. Wages is the description. Expense is what's going on. Expense of paying people for their labor. So you can have all kinds of different expenses. That first word is going to be the description of what the expense is. How much we pay them? Say $700. Oh, $1,000. All right. $1,000. And again, employees like to be paid with money. $1,000. We post it to the ledger accounts. Wages expense. And a credit to cash. And if you're one of these people that are like at this point, how do you know? How do you know what's the debit and what's the credit? Well, I've been doing this for 20 years now, and I don't want to date myself a whole lot, but I've been doing this for quite some time. So for me, it's natural. I've been doing it for a long time. It's like driving a car. I know where the gas pedal is. I know where the brake is. I know where the clutch is. I don't have to think about it. I just do it. As you're starting out, you have to think about it a whole lot. Maybe you have to look at examples. Maybe you have to have notes out before you can do a transaction, and that's totally fine. It takes practice before you have it down pat. But if you're completely still fogged, I suggest that you go back, look at our lectures from chapter 1 and 2, and remember the general rule of thumb. On the asset side, it goes up on the debit side and goes down on the credit side. Over here, it's the opposite. On the right-hand side of the equation, accounts go up on the credit side and they go down on the debit side. You just have to memorize it. And I hate that there's no shortcut, there's no magic formula that I can give you, because I like things that are easy. I like things that don't take a lot of brain power. But sometimes you just have to grin and bear it and memorize and commit it to memory. So that's kind of one of these deals. You just have to keep plugging away. So if you're one of the people that are kind of like, it's still kind of fuzzy, I still don't quite understand, I urge you to just keep plugging away. Just keep at it. And eventually it will click for you. That's my pep talk, my 25-minute lecture pep talk there in the middle. Assuming anybody's still watching at this point, which maybe is an erroneous assumption. I don't know. Maybe you've all gone asleep. There's our complete general ledger after that transaction. So the key point, and I've said it a few times already, when you record an expense, you're almost always recording a debit, left-hand side. The exception is if you're fixing something you've boogered up, or if you're closing an account at the end of the period, like we'll look at in Chapter 5. Transaction 4, you all ready for another one? We sell again. February 10th, Gray Company makes a sell of inventory. Customer comes in, buys something. Inventory is sold for $4,500, but this time, customer's going to pay later. We're going to let them pay later. That's called account receivable. We expect to receive money from that customer. If we don't receive it, then maybe we send somebody to their house with a crowbar and we bust a few kneecaps until we get our money. We expect to get that money though. The inventory is sold, that we sold, we paid $2,000 for. So we have a sale of $4,500. We paid $2,000. 2 transactions there, right? We sold something. What did we get? And then what did we pay for it? And we got to get rid of that inventory. So what date was that? 2/10. So first part, we sold something. We got to record the fact that we sold something. The customer didn't give us any money. They gave us an IOU. When a customer gives us an IOU, we let them buy without paying in cash at the time, we call that a receivable. Specifically, an account receivable. So we record accounts receivable. That's an asset going up on the debit side, going down on the credit side. Customer buys something, says they'll pay later. Account receivable goes up. In this case, $4,500. All right, that's my account receivable. And we got to record the revenue. Sales revenue. The sales says how we got that revenue. We got it because we sold something. We might have interest revenue, where maybe somebody owes us interest on a loan that we made. So there can be different kinds of revenue. Sales revenue generally refers to us selling a product, a physical, tangible product. All right. Maybe if we're Kings Island, it could be ticket revenue. Or maybe if we're Great American Ballpark in Cincinnati, maybe we have concessions revenue and ticket revenue. So we can have different kinds of revenue. The description here, sales revenue, just kind of indicates we're selling a product. Second part of that entry, we paid $2,000. So cost of goods sold, what did we pay? We paid $2,000 for that inventory. $2,000. Inventory's going away. We no longer have the inventory. The inventory goes down on that credit side. $2,000. So I'm going to post all these to my little ledger accounts I've got going on here. I had $4,500 debit to account receivable. Throwing that into sales revenue on the credit side, I had $2,000 debit to cost of goods sold. Taking that out of inventory. Right on. Posting, I do it exactly like I made my journal entry. I just take that entry and bump him on down. If it's a debit in my entry, it's a debit when I post it. I don't need to flip anything. So what do we got going on now? At this point in time, we have $13,300 in cash. We have an account receivable here. We've sold $13,500 in products. We've paid $7,000 for those products that we've sold. Cost of goods sold expense there. We got some wages expense, rent. Oh, but look here. Inventory. We have 0 left on the shelf. We need to buy some more inventory, don't we? So that's where we're going to pick up with the next video. We'll talk about buying some inventory, and we'll go through a few more transactions in the month of February, and then we'll make our financial statements for the month of February. So Chapter 4 homework problem. If you want to jump into that and work February 1 to February 15, you can do that right now. And then maybe take a little break and come back and watch our second part of the video. Or if you want to be one of those people just to plow through the whole 2 videos, you're welcome to do that too, and then tackle the homework all at once. But I'm trying to break it up into little chunks for you to make it a little bit more manageable, because some people just can't sit there for an hour and 15 minutes. Their accounting cup overflows. And as much as I try to pour more in it, once your accounting cup starts overflowing, it doesn't do me any good to pour more in it. So you got to take a second, drink down that accounting, and be ready for more. So whatever you need to do to keep your accounting cup at an appropriate level for learning, you do that. And we'll see you back here for part 2.